few months ago, we looked into CVS Corp rating the stock at 10 out of 10. And glossing over the Financial Pro's top picks, according to TrackStar, a proprietary sentiment indicator, UnitedHealth Group caught our attention. We weren't impressed with its valuation compared to CVS. We've now had a second look at UnitedHealth, which we rate at 8 out of 10, and it turns out we misunderstood the company's business model. And while it doesn't deserve top billing, it does warrant more credit than last time. Most of us are familiar with UnitedHealth's core insurance business. However, the real juice came in 2011 with the creation of Optum, a subsidiary which provides a wide range of healthcare solutions. And then in 2022, UnitedHealth acquired the software and data analytics firm Change Healthcare for $13 billion. Insurance brings UnitedHealth the most revenue, but Optum is far more profitable, with top-line growth circa 25% compared to 13% in insurance. Margins continue to expand as Optum makes up a greater percentage of total revenues and profits. UnitedHealth carries a pretty big debt pile, but with billions in operational cash flow and low interest expenses, it's manageable enough for the firm to consistently grow its dividend. Now, in terms of valuation, it isn't cheap on PE or PE growth measures when compared to its peers, and its price to sales and price to cash flow are far higher than those of CVS. However, UnitedHealth is the only stock in the group expecting to see revenue growth of over 10% next year. It also boasts some of the highest margins, with gross margins that are nearly 50% higher than CVS. UnitedHealth has a net income margin that dominates the group, and that's helped it achieve top marks for its return on equity, assets, and capital. It's tough not to like UnitedHealth, even at these prices. It consistently delivers outstanding revenue growth alongside expanding profits and margins. That said, we'd be more interested in the stock nearer to $400, where it becomes a 10 out of 10.